Welcome back to the Market Mosaic, where every week we are taking a look at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment. This week, all of a sudden, we're seeing a big injection of volatility on Friday. President Trump coming out and threatening 100% tariffs on China that came after China was starting to announce some things around the export bans, export licenses needed for rare earth elements, an industry that it absolutely dominates and that the U.S. relies on. And so we're seeing this tit for tat exchange here once again. So a really sharp sell-off in the markets on Friday. We had some pretty incredible volatility in the crypto space as well. And look, to start the week, you're going to see the headlines around these developments coming fast and furious, but you could do much better to just be objective, take a step back, and look at how things are evolving, especially with breadth and sentiment. So here's what I want you to look for. First, on the investor sentiment side, you're already seeing sentiment swing back into a pretty extreme fear condition. So CNN, their fear and greed index back deeply into fear territory. It's taken a long time for the AII's investor sentiment gauge to get back into a bullish state. I'm willing to wager when that's updated this week, it's going to show a sharp swing back toward bearish views. And so when you start to see too much fear in the market, remember this operates like a contrarian, or this is a contrarian indicator. It pays to do the opposite. So when there's too much fear in the market, that's when it pays to get greedy. But the one other condition that I want you to look for, I want you to look for an oversold breadth condition. So breadth is a great tool to flag when the stock market's upside could be on shaky ground, or when the sell-off, if we see a sell-off, the sell-off's going too far. And here's one breadth example that's a great example of both of those conditions. So this is the percent of stocks across the market trading above their 20-day moving average. That's the black line on here. The blue line is the S&P 500. And so really since the end of September, you have seen a growing negative breadth condition. So as the S&P has rallied out to new highs in October, you see this sharp deterioration in the black line, the percent of stocks trading above their 20 days. So that means as the S&P is rallying, fewer and fewer stocks were in short-term uptrends. And at one point, not too long ago, just recently, as the S&P was still holding at new highs, you had 50% or fewer of the stocks across the market in a short-term uptrend. And so that was a major warning to be on the lookout for some downside. And we had that, but here's the thing. This metric, it won't take much more downside to get this metric to a very oversold condition. So it's at 30% right now, 20% or lower historically. See, it's been a while since we hit that, but we had it back in April. You had that during the initial round of the sell-off around trade war headlines. They had a brief relief rally. Under that 20% or below is what you want to look for an oversold breadth condition. If we can get that, along with seeing this extreme investor fear already coming back to the marketplace, those are good conditions to help support a rally. But here's the thing. This all it feels like a big distraction. This feels like a big distraction from the things that should concern you. And the thing that really should concern you is the currency debasement trade. So the trade, the assets, things that should be doing well if there is a growing concern around fiat currencies. And look at the things that have been happening here recently. You had gold hitting $4,000 per ounce level for the first time ever. Silver is testing the prior record high around $50 per ounce. We did have precious metals pulling back, had some volatility late last week, but look, gold's still up 54% on the year. Silver's rallied 73%. And the tailwinds behind the gains and the assets sensitive to currency debasement are not going away anytime soon. That includes the concerns over the future of fiat money at a time when fiscal imbalances keep growing. Look, there's been worries over the debt levels and deficit spending for as long as I can remember, but now maybe investors are finally starting to care, and that is because the U.S. debt to GDP ratio in here, that's what this chart is showing. The debt to GDP ratio stands at about 119%. That is up from 60% just 20 years ago. And even though the government remains partially shut down over funding disagreements, the deficits that are fueling this rising debt levels, this rising debt relative to GDP is not going away anytime soon. Total deficit spending over the next decade is estimated at 22.7 trillion. That is an average of 6.1% of GDP every year. So again, deficit spending averaging 6% of GDP every year. And look, that assumes that the economy continues expanding. Look at some of these past episodes where you see a sharp rise in debt to GDP. It comes during recessions. That's because of automatic stabilizers, things that the government does to support unemployed, but then also stimulus measures taken to support the economy. So that's why you see a jump in deficit spending and a jump in these debt levels on here during these shaded areas, which are recessions. So, again, these projections on the total deficits over the next decade assume the economy continues to grow. So this could be even worse if we do see that recession on the horizon. And look, there's more behind the debasement trade. Worries over the future path of inflation that could erode purchasing power. That's playing a role. The minutes of the Fed's most recent rate-setting meeting is another cause for concern too. And that's because it shows the Fed is staying on the easing path for now. Look, it's not unanimous. Comments from the Fed show there are a deep division at the central bank and whether the employment or the price stability mandate is of greater importance. But a statement in the minutes even noted that progress on inflation, and this is what it said had stalled, even excluding the effects of this year's tariff increases. Despite that, a slight majority of the FOMC on the Fed's rate-setting committee favored cutting interest rates by a quarter point at each of the Fed's last two meetings this year. And so the focus remains on supporting the labor market, but lowering rates could add upward pressure to inflation. So let's take a look at what's been going on with this scarcity trade, this debasement trade, and the key breakouts that we want to keep an eye on: precious metals and cryptocurrencies, because I don't think we're done here yet. We'll also look at why currency debasement could help stir inflation at a time when leading indicators of inflation are already pointing to trouble ahead. And I also want to look at the levels on inflation that could start to impact market valuations. So this rally in gold prices, it really started to go mainstream last week. So gold originally started breaking out to new record highs by holding over the $2,000 per ounce level in late 2023, but prices have doubled since then. Gold's recently touching the $4,000 per ounce level, and that is too much fanfare, gaining a lot of attention last week. My social media feed was lighting up with everyone pointing out gold, marching toward that $4,000 per ounce level. Well, silver's rally is starting to gain more attention, but it remains an underfollowed scarcity trade, in my opinion. The other thing that makes silver attractive is that it has various industrial end uses that are linked to the artificial intelligence infrastructure build out. And silver prices are now testing the prior highs around the $50 per ounce level. You can see we hit that back in, I think it's 2011, I believe, touching their $50 per ounce. If you took this chart back even further, in the 1980s, you would see we're testing this level. Well, we are right there once again. And there's some reasons why this doesn't mark another near-term top or a major top for silver. I believe silver could follow in gold's footsteps in moving out to fresh record highs. Okay, and that is because while this currency debasement trade remains in play, silver's valuation relative to gold is also supportive of momentum favoring the silver trade. So this chart plots the ratio of gold prices relative to silver prices going back to the early 1900s. A rising ratio. So when this line is rising, that means gold is outperforming silver, and vice versa. When it's falling, it means silver is outperforming gold. And you can see the ratio right now is recently back to the high end of the historical range following, this period where we've had gold's breakout to new highs, and it's moved to that $4,000 per ounce level. That ratio shows that silver is near historically undervalued levels at a time when silver is testing its own breakout to new record highs. So this $50 level in silver has remained a major top in place, been tested on several occasions. I think we get through it this time, and I think this ratio it supports that breakout, that move in silver to new record highs. All right, so we had some news over the weekend between tensions flaring again between the U.S. and China, weighing on a variety of risk assets. So that includes a sharp pullback in cryptocurrencies, along with, again, a broad risk-off move we've had in various markets. But look, just take a step back, look at the big picture, and you can see that cryptos, especially at least the big crypto, the larger cryptos by market cap, are simply consolidating some of their recent gains. Look, Bitcoin started moving out to record highs in 2024. Its breakout has taken Bitcoin as high as $125,000. And similar to how gold is leading new highs in precious metals, Bitcoin is leading the way in cryptocurrencies. And just like I believe silver could follow gold to record highs, I believe Ethereum could be setting up a breakout to catch Bitcoin. So this is a weekly chart. This shows Ethereum coming back and once again testing this $5,000 level that was tested in late 2021. And you can see, yes, prices have pulled back. We were trading in this range right here. It was nice to see this holding above the $4,000 level on Ethereum. That gave way with last week's volatility. But even with that move, you can see we've had, since the sell-off into April this year, we have had higher lows in place with Ethereum and higher highs along the way as well. So this overall uptrend in Ethereum has not been violated yet, and I would still look for Ethereum to turn around and come back to test this 5,000 level once again and see a breakout to new highs, as Bitcoin has already been leading the way. Precious metals, popular cryptocurrencies, they've seen a boost over currency debasement concerns, but that's coming from increasing money supply around the world and surging government debt levels. But another symptom of currency debasement could be it contributes to an inflationary wave in the months ahead. And so we're already seeing the warnings on inflation. This chart plots the prices paid component from various Fed district surveys of purchasing managers. So these purchasing manager indexes, or PMIs, they survey business executives and they ask them things about how employment trends look, how their new orders look, inventories look. Well, I'm asked about prices paid, which is basically changes in raw materials and other input prices for these businesses. And when as you would expect, when they see higher prices, they tend to pass that along in the form or on down the line, which shows up eventually in consumer inflation figures. So that is why these prices paid components tends to lead changes in consumer inflation. So consumer inflation on here, the PCE, that's this green line. We've got these PMI prices paid indexes from the Philly Fed, the New York Fed, Kansas City Fed, and the Dallas Fed, and they're moved ahead by 6 months. So you can see, we're at a point where these started to inflect higher back in April, and that is pointing the way higher for PCE consumer inflation here in the months ahead. So one thing to be concerned about with inflation is, when could it really start to impact stock market valuations? So the rally in the S&P 500, that has brought the trailing price to earnings ratio to almost 30 times. In the forward price to earnings ratio, they're using estimates over the next 12 months for earnings. That figure sits at 22.8. That forward PE is the highest since the internet bubble in the late 1990s. And if inflation does accelerate further in the months ahead, you could see that significantly pressure stock market valuations. So, and that's because high inflation tends to lead to higher interest rates. That makes the present value of future corporate profits worth less. In today's terms, that can be especially impactful for growth stocks that where a large chunk of their earnings reside way out in the future. They can be more sensitive to that. And what this chart shows is the average S&P 500 PE ratio using this scale based on different inflation ranges across the bottom here. And what you can see is that, as you go from inflation under 2% to inflation in a range of 2 to 4%, there's not a big impact to the average PE applied to the S&P 500. But as you start to go above 4%, now all of a sudden you start to see a significant deterioration. Now remember, core consumer inflation right now is running at 3%. So keep a close eye. If we see core consumer inflation keep rising here, and we start to get above that 4% level, that's where you could really start to see inflation concerns take a hit out of the market, because we haven't seen it so far. The disinflation trend since mid 2022 has stalled out. Inflation is at 3%, well above the Fed's 2% target, yet the market keeps marching to a new high. Well, watch for inflation to go above 4% to really start to see an impact to valuations. One other thing I want to talk about this week is the message coming from copper. So we had this sudden injection of volatility into the market. There's a lot of questions swirling around the Fed, questions around the health of the labor market, questions around inflation. Well, this is why you could do very well by just taking a step back and looking at charts across the market that are sensitive to the economy and what they could be telling you. And this is where I think you need to keep a close eye on copper. Now, there could be some supply-driven things happening with copper right now. There's some major supply that's supposedly going to be cut off following some weather-related events, I believe, in Indonesia. But the pattern you want to watch right here with copper, and this is LME copper, so this is on the London Metals Exchange. It's hard to follow what is happening with U.S.-listed copper because of some announcements around tariffs that were present and then went away. The U.S. imports a lot of the refined copper that it uses, and if you look at a chart of copper traded on the CME, you see this huge spike and then this sharp drop as tariff threats were there and then tariff threats were removed. This gives you a cleaner look at what copper prices on a more global benchmark are actually doing. And this is a bullish chart pattern. This looks like an ascending triangle pattern where you have higher lows forming in the base. So we've had higher lows since 2022. And you have this resistance being hit around this 11,000 level, again on copper. So watch for a breakout over that level. If we see a breakout here, again, there can be some supply concerns driving this. But at the same time, this is sending a message on the global demand backdrop. So, look past the scary headlines, everything you're going to be hearing about after we had that sudden burst of volatility last week. Focus on the message that copper is saying about the global economy. For upcoming data this week, again, government remains partially shut down. So all these reports that are listed on here that would be coming up or that are trying to get caught up with, like the non-farm payrolls report, this is not going to happen until we get a resolution to the government shutdown. So a lot of these numbers like CPI, retail sales, again, non-farm payrolls, this is not going to come out, but likely not going to come out next week. So keep an eye on alternative data sources. And we're still going to get speakers, so that's not going to restrict Fed Chair Jerome Powell delivering a speech. So maybe we can get some clues about what the Fed is watching during their final 2 meetings of the year and the likelihood of seeing rate cuts at that time. But right now, you really need to rely on alternative sources of data and private sector sources of data to figure out what's happening with the underlying economy, especially as it may impact the Fed's view on hitting its mandates across labor market and inflation. One chart setup I want to keep an eye on this week is with GEV. GE Renova, and that is because before we had all the tariff headlines coming around late last week, one thing that was making the rounds on social media is the enormous sums of money going into the data center build out as part of the AI trade. So the expansion in AI and AI applications relies on data centers to run those applications, and there has just been this enormous amount of money going into data center construction, and those data centers are power hungry, which sets up GEV well here. I like to look, we know what all the typical trades are in the AI space. I like to look for off the beaten path, under followed, pick and shovel trades, and GEV via various power systems that they're involved with, whether it's natural gas turbines or nuclear power. They are exposed to the AI trade via that energy demand from data centers, and so that's the tailwind. Now we can look at the chart to tell us when's the time to go into the stock, and we've got a nice basing setup developing here. We had the stock peaking out near the 675 level back in July and has been trading in a pretty tight range ever since then. So this just becomes a sit and wait and watch this chart as it evolves, and we are looking for a breakout to new highs out of this base over the 675 level. Ideally, we can see some smaller pullbacks emerging. That would verify that the institutional space likes this name as well, and that you're seeing demand for the shares there. So keep an eye on this basing pattern in GEV. All right, that is all for